All right. So my name is Michelle Sulik, and I'm Community Affairs Specialist with Elevations. I just recently celebrated my 10th anniversary, and before that, I was a school teacher in the St. Vrain Valley School District. Today's webinar, we hope to help you get your real estate investment dreams off the ground, and especially in this highly competitive market along Colorado's Front Range. So a few technology items. Your questions are very important to us. So please type them in utilizing the Q&A buttons at the bottom of your screen, and I will be facilitating them for Erin. Another item is for if you do have a question that is a little bit unique or anything, just send me a private message and I can handle those as well. So it is my extreme pleasure to introduce you to Erin Staufer, Mortgage Loan Manager with Elevations. And it's great to see you today, Erin.
Likewise, thank you.
All right, so well, let's get started. I will go off video, but then again, I will come back on when we have a few questions, okay?
Perfect, beautiful, thank you.
Sounds good.
All right, well, thank you so much for spending a little bit of time with us today. A little bit about me before we get into buying investment properties. So I've been in the mortgage industry now for 13 years. Prior to that, I actually had my real estate license. Got my real estate license in 2008, which was the single worst year ever to get a real estate license. It was brutal. I sold 2 properties. One sold for $75,000, one sold for $46,000. So I was not keeping the lights on. I was actually about to join the military and I got recruited into lending. And I've been doing that ever since. It's been a much better fit for me. I love what I do. I love the education part more than anything else. So this is right up my alley. When I'm not doing mortgages, which honestly right now is 11 to 12 hours a day. I love going on motorcycle rides with my dog Finian. If you ever see an Iris in a sidecar, that is Prince Finian and his driver. I like to go scuba diving. Until recently, I was a volunteer diver at the Denver Aquarium. I love playing soccer and doing yoga. And I just absolutely love dogs. I will cross the street to pet a dog. I just absolutely love dogs. So that's a little bit about me. So experience with residential rental properties. I personally own 5 rental properties. When I was doing real estate, since I was not so busy on the sales side, I was doing a lot of property management. So you'll hear some of my horror stories and things to keep an eye out for when you're looking at tenants and tenant management. So we'll be talking about that a fair amount as well. I've managed my own rentals. I've managed other people's rentals when I was doing property management. And then more recently, I've hired a management company to take care of that for me. So we'll be talking about kind of all of that. So yeah, if you have a question, I'll certainly have an answer for you. Here's what we're going to be covering today. We're going to start off with what is an investment property. Seems kind of obvious, but it's not necessarily. We're going to be talking about difference between residential and commercial real estate. My purview, my area of expertise is residential. So we're going to be talking about that. I will give you a resource for commercial. What are the advantages and disadvantages of owning rental properties? There's definitely pros and cons to it. Financing requirements, we're going to be talking about the differences in the types of properties, what defines what a single family residence is versus a condo versus a townhome. Ask yourself the question if you should convert your current house into a rental. I've got plenty of opinions on that as well. We'll be talking about tenant management. We'll be doing some number crunching, actually going into the weeds, figuring out how do you compare different types of rental properties to figure out what you're going to get, how you're going to get the most bang for your buck. So we're going to be talking about all of that. I mentioned all of that. As you can see, it's rather extensive. And I really mentioned that to tell you what we're not going to cover. So here's what we're not going to cover. How it compares to other investment strategies. It is not my job to convince you that you really should be investing in real estate. I will let a real estate agent do that. Real estate is a completely different investment strategy than stocks, bonds, mutual funds, cryptocurrencies, any of that. So I'm not a financial advisor. I don't pretend to be. I do advise on financial matters because that's what a mortgage loan officer does. But I'm not going to try to convince you, hey, investing in real estate is a better avenue than investing in a different type of investment strategy. I'll tell you the pros and cons. I'll give you the facts, but I'm not going to get into the weeds of stocks historically returned this percentage and real estate historically. That's not really my job. Okay, my job is to ultimately explain how to qualify for a mortgage, get you into a house, and if it is a right fit, perfect. That's ultimately my job. What are your specific tax consequences? This doesn't come up as much on Zoom, but when we were doing this class in person, we would very quickly go down rabbit holes. Well, I'm a Schedule C and I have these many tax deductions. Should I be doing investment properties? Like, oh, geez, I'm not a CPA. I don't pretend to be one. I don't want to be one. So specific tax consequences of your scenario and whether or not you should be personally be investing in real estate, consult your CPA. They'll be able to give you better advice than I ever could on that front. And then again, why you should invest in real estate as a whole. I'll tell you the pros and cons. If you really want somebody to convince you whether or not you should invest in real estate, talk to a real estate agent. They would be very happy to have that conversation with you. So that's a little bit about what we're not going to be talking about. If you do have specific questions, let me know. I'm more than happy to answer whatever questions I can. If it is, again, in one of these kind of bubbles, I will refer you to somebody else. But please don't let that slow you down from submitting questions. I love questions. It's my favorite part. So, all right. So what is an investment property? Let's get going. There's ultimately 3 different types of properties. Okay. There's a primary residence, a second home, and an investment property. A primary residence is a residence that you buy, and you have to meet 2 criteria. 1, you intend to live in the property within 60 days of closing. You intend to live in the property within 2 months of closing. Okay. Number 2, you intend to live there for 1 year, for 12 months. Okay. I mentioned that it's actually going to fold into one of the investment strategies that we talk about a little bit later. But I mentioned that because people always ask the question, hey, I've lived in my house for, a couple of years. I think about moving into a new primary residence and maybe converting my current place into a residence. Do I have to refinance my mortgage into an investment property? Definitely, definitely, definitely not. Okay. Once you've done those 2 things, moved into the property within 60 days of closing and lived there for a year, you've done what you signed up to do. Okay. So you don't have to change the terms of your current loan or anything like that. Once you've done those 2 things, you've done exactly what you agreed to do. Okay. And then the other key word in there is intend. I intend to live there for 12 months. I've had people buy a house before. They were coming out here for a job and they never started the job. They actually got laid off before they even started. They didn't commit loan fraud. It wasn't their intention to get primary residence financing and not do that. It was their intent going in. That's all ultimately we can judge is what is your intent going in. Okay. So that's a primary residence. It's where you spend your days and nights. It's where you're currently living. Second home. A second home is a property that's significantly far away from your current residence. Significantly far. What does that mean? The general rule that lenders will use is 40 to 50 miles as the crow flies. However, since we only lend in Colorado, my underwriters are very aware that a house that might not be 40 or 50 miles away still is geographically different enough. So if you're buying a house up in a ski town and you intend to live there part of the year and your primary intent is not to rent it out, you've automatically met the requirements of a second home. Okay. It may or may not be 40 to 50 miles away, but it's geographically different enough. My underwriters are familiar with Colorado. They know how different areas are, and they know you might not have to drive 50 miles away to get into a very different geographic location. So second home, primary intent is to live in it part of the year. Your primary intent is not to rent it out, and it has to be significantly far away. That's the requirements for a second home. That doesn't mean you can't rent it out occasionally. It means your primary intent is not to. Okay. Ski condo, that kind of thing is a slam dunk no brainer typically for a second home. You plan on spending some of your winters there. That's your primary intent. And then an investment property. An investment property, your primary intent is to rent it out. Okay, long-term lease, short-term lease, does not matter, but your primary intent is to rent it out. That is the definition of an investment property. Differences between residential and commercial, and they are drastically different. The running joke is that we laugh at what commercial lenders do and commercial lenders laugh at what we do because we look at things completely different from one another. Residential, so again, my sphere of influence. The buyer is the primary concern. We are primarily concerned about your qualifications. We will lend on 1 to 4 units. So single family residence, condo, townhome, duplex, triplex, fourplex, okay? Has to be at least 1 unit, so it can't be vacant land, and it can't be more than 4 units. If it's less than 1 unit, more than 4, commercial is gonna be your go-to, okay? With commercial, their primary concern is the property. They care about the property you're buying and what kind of income stream it's going to have. Sorry about that. With residential, zoned residential or mixed use. So it could be zoned agricultural and residential, that's fine. It just cannot be zoned. It has to be at least allowable for residential financing. Residential, makes logical sense, has to be allowed to have residential units on the property. With residential, the appraisal is focused on the value of the property. Compare that to commercial, their appraisal is focused primarily on the income that the property can earn. Makes some sense, right? If you're buying an apartment complex, we're less worried about the value of the complex as a whole. We're more worried about how much income will that project create. That's commercial's concern. Their appraisal is primarily focused on income. And that is one way to create value out of a property. A property could be worth what somebody's willing to pay for, what other houses in the neighborhood are selling for. It could also be worth, they call it an income calculation. How much income will that property create? You can actually create an appraisal value based on how much that property is going to earn. Residential, best interest rates. Those are backed by Fannie Mae and Freddie Mac typically. Okay, Fannie Mae and Freddie Mac are the government-sponsored enterprise behind mortgages, so that you can do a 30-year fixed. 30-year fixed mortgages did not exist before Fannie Mae and Freddie Mac came around. Once Fannie Mae and Freddie Mac came around, they established that market. They created a mortgage-backed security for it, and 30-year mortgages were born. That does not exist on the commercial side. Commercial sides are typically lower loans, lower term loans, shorter term loans. They will have a balloon payment and you'll have to refinance every so often to keep your loan active. 5-year term is very common for a commercial loan. On the residential side, 2 years of tax returns is typically required. Commercial, they typically want 3 years. Residential, we can close in 30 days. Right now in this market, we're closing a lot quicker than that. Anywhere from 2 to 3 weeks is what we're seeing right now in this market. 3 weeks is kind of the new 30 days. It's kind of the new standard. Commercial takes longer, 45 days or plus. It's very common for commercial loans to take longer. They look at things just drastically different than we do. So residential, again, 1 to 4 units, has to be at least owned residential in nature. If we appraisals focus on the value, we can do a 30-year fixed all day long, close in 3 to 4 weeks very easily. We're going to be focusing today on residential. If you are interested in commercial, again, vacant land, construction loans, more than 4 units, you should be talking to this guy, Todd Payak. He is our VP of commercial lending, okay? VP of commercial lending. He will do all things commercial, vacant land, construction loans, more than 4 units. All of those are his area of expertise. Okay. So if you have any questions, please reach out to Todd Payak. I do joke that Todd is a little bit of an outdoor cat. And by that, I mean, I am an indoor cat. I sit in front of my computer every day. That's what I do. Todd is usually out and about. He's out surveying properties. He's out making connections. So if you don't get a hold of Todd, try him again. Super nice guy, a wealth of information. Do not feel like you're hassling him. If you don't reach him the first time, try him again. So why have an investment property? I told you at the offset, we're not going to really be talking about how it compares to mortgage, stocks, bonds, mutual funds, that kind of thing. But I will tell you how some similarities and differences between them. Okay, so real estate is unique. It does not move in the same way that other investments move. Okay, however, there's one thing that they have in common, which is that there's 2 primary investment strategies. Okay, you can buy for appreciation or you can buy for cash flow. Okay, buying for appreciation. A fix and flip is a great example. You're going to buy a house that's kind of, worse for the wear, has a lot of deferred maintenance, that kind of thing. Your goal is to fix it up and then resell it. Buying it at value A, you're going to be selling it at value A plus B, right? That's a great example. Your cash flow is the least of your concerns in that situation, okay? Your primary concern is how much is the house going to be worth in the future. It's most comparable to a growth stock. Okay, you bought Tesla when it was dirt cheap, right? And now it's going to increase in value, and then you're going to sell it when it's increased in value. The same kind of principle, right? Fix and flips are a great example of that. all houses should be appreciation. Not all, no one property is only going to fit into one category. Typically, they're getting a little bit of both of these. But you got to ask yourself, what is your primary concern? Okay. You can also buy for cash flow. Cash flow is like a dividend paying stock. Okay. It may not increase in value a whole lot, but the cash flow is great. It's a longer term strategy. I've got friends that invest in Section 8 housing. Not in Colorado, they're out in Oklahoma and Texas, but they bought up a whole lot of properties that they were able to acquire for very, 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 very little. And the government is essentially paying the rent. That's what Section 8 housing kind of is, right? So in that strategy, I asked him, I was like, do those houses increase in value? And he's like, oh, good grief, no, not at all. Zero appreciation, zero appreciation. His strategy was cash flow. He was just buying it because the rent is going to be more than his payment, and he's receiving that money each month. Okay, it's like a dividend paying stock. And again, most houses, very few, we touched on like the two examples that fit into each category nice and pretty. Fix and flips, you're going to have zero cash flow because you might not ever rent them out. You're just going to fix it up and sell it. No cash flow, but you're buying it for appreciation. Section 8 housing, you're buying for cash flow. You're not buying for appreciation. They don't appreciation at all. So we talked on like the two types of properties that might fit nice and pretty into each of those categories. Very rarely is that the case. Most properties you're going to get some of both, right? Most stocks you get some of both. So that's how real estate can compare slightly to different investment strategies. You do want to ask yourself going in, which of these investment strategies am I going to focus on? I will share with you at the end my investment strategy and kind of the path that I went forward. It's anecdotal. It's my personal case study. It doesn't apply necessarily to you, but you do want to ask yourself going in, what is your primary concern? Okay. What are the advantages of real estate? There's a number of them. The biggest, by far and away, and it's very unique to real estate, is that real estate is highly leveraged. What do I mean by that? This is a nice little diagram, right? So if you're the consumer and you're trying to buy a house, how do you acquire that? Well, you acquire it with a home loan. That is the leverage, right? You don't have to put down 100% of the value of real estate to earn 100% of the appreciation on that real estate. That's very unique to real estate. If you're a first-time home buyer, you can put as little as 3% down on a house. So you can put 3% down on a house and you get 100% of the appreciation moving forward. 100. The lender doesn't step in and say, hey, some of that appreciation is mine. Oh, no. 100% of that appreciation is yours. So long as you make the payments, 100% of the appreciation is yours. Okay. If you're doing it as an investment property, you can put 20% down. Most investors find they have to do 25% down to make the numbers work, but you can put 20% down in a house. You earn 100% of the appreciation. You don't see that with stocks, bonds, and mutual funds. Unless you're buying on what they call margin, you don't really see that. So that's one thing that's very, very, very unique to real estate, okay, is the leverage. We're going to look at an example in a little bit here, which puts it into numbers a lot better than my words do it justice, but it makes all the sense in the world. If you can to obtain financing on an investment property, using that leverage is going to be what turns real estate into a game changer, in my opinion. Love investing in real estate. I did the whole Warren Buffett thing, invest in what you know. Leverage. It's very unique to real estate, and it's the single biggest difference maker, in my opinion. Okay. If you want to go buy stocks, you typically have to pay a dollar for dollar for that stock. Not with real estate. You could put 15 cents for the dollar and earn 100% of the appreciation. Like, that's very unique to real estate. Another advantage is diversification. When COVID-19 happened and we very abruptly fell into a recession, stocks and mutual funds were really struggling. Real estate, if you've been in this area for longer than a day and a half, has been performing very, very well. Okay, real estate historically performs very well during recessions. The one obvious outlier to that, the one exception to the rule, is the Great Recession of 2007, 2008. In that situation, it wasn't the recession that caused real estate prices to bubble, pop. Real estate was the virus that caused the recession. Real estate wasn't a symptom of the recession. It was the virus that caused the recession. And there's a big difference there. If you go back through history and you look, time and time again, real estate performs very well during recessions. 2007, 2008 is the one, again, outlier to that rule. Okay. So it does not move in the same way that stocks and bonds and mutual funds move. Okay, real estate moves independently of it. Real estate is also tangible. You can touch it, you can physically touch it. It exists. It offers concrete value. You can live in it. That is unique. Try living in your Apple stock. It doesn't really work, right? So diversification. It doesn't move in the same way that stocks and bonds and mutual funds move. It offers concrete value because you live there. You buy land, one of the few things they're not making more of. So there's that. It offers you diversification relative to other types of investment assets. So if you have a portfolio that's very heavily inundated with one type, yeah, it might not be a bad idea to diversify, not just diversify within your stock portfolio, but diversify into different avenues. Real estate is an avenue. Another advantage is the tax benefits. So this one, when we start getting into the weeds a little bit, okay? So one advantage of real estate is you get to claim what they call depreciation. Depreciation is the IRS saying that over time, assets erode. They decrease in value. They fall apart. They eventually erode and fall apart. I mean, that's why you have to invest money to replace the carpet and the paint and the siding and all that, is to make sure that it doesn't depreciate and does not erode and fall apart. Okay. You have a couple different ways of handling depreciation. You can take what they're going to do if you've never owned real estate before. When you go to file your first year of tax returns, they're going to say, hey, great, what's your purchase price of the house? What was your land value? They're going to take the difference between those two numbers and figure out what your structure is worth. Okay. You will take that, you'll divide it by what the government's figure is, 27.5. Okay. They figure if you do absolutely nothing to your property after 27.5 years, it's going to be nothing. It's going to fall into disrepair and be worth basically nothing. So you'll take the value of the structure divided by 27.5, and you can claim that depreciation on a yearly basis. Okay. Or you could claim it at the very, very end when you go to sell your house. Which option should you do? As I mentioned at the very beginning, I am not a CPA. You should consult one. Okay. It depends on your strategy. For me, first glimpse into my world, I'm never planning on selling my investment properties. I'm planning on holding on to them forever. Eventually, I'll be cash flowing 100% when the mortgages are all paid off. And it makes the most sense for me right now to take the depreciation on a yearly basis, which this is actually a screenshot from one of my rental properties when I was first doing my tax returns on them. You'll see you claim your rental income at the very top, and then you have all your expenses. You've got cleaning and maintenance, you've got your insurance, you've got your management fees, interest that you paid on your mortgage, taxes, depreciation. If I didn't have this large write-off, $4,258, this bottom line here in line 21 would be positive, which means it would increase the amount that I have to pay in taxes. That is taxable income. Second, I take that write-off, $4,258, now all of a sudden, this number is negative, and I no longer have any income that can be taxed on that. Since I'm not planning on selling my properties, it made the most sense for me personally to take that depreciation on a yearly basis, because you can take them out at the very end when you go to sell your house. However, if I'm not planning on selling, then it would really only be doing my heirs a benefit and not myself. So, and to clarify, I did have one person ask me, are you saying that when I go to sell my house, I can just take 27.5 years of depreciation? No. You can take the number of years you've owned the property. You can take that many years of the depreciation. Okay. You can't just 27.5, even though I only owned the property for 3 years. No, you would take the value of the structure divided by 27.5 times the amount of years you've actually owned the property. Okay. Again, ask your CPA which route is best for you. It depends. Okay. You will not see people that are doing fix and flips taking their depreciation on a yearly basis. They're taking it as a one-time expense. So ask your CPA, they will know better than I will. Another advantage of investment properties with regards to taxes is what they call a 1031 exchange. Okay. A 1031 exchange is a way to defer paying capital gains. Defer is the key word there. You are not avoiding paying capital gains. You are deferring paying capital gains. Big difference there. Okay. 1031 exchange gets back to kind of old times where people wanted to move out of the city and they wanted to move into the agriculture arena or a little bit more rural. And then people who were more rural wanted to move into the city. So they would literally do a swap and they would literally exchange their properties for one another. Defer paying capital gains in the process. So with the 1031 exchange, and I've done 2 of these personally myself. We have a lot of people that do financing. A lot of people that are getting mortgages on properties that they're also doing a 1031 exchange on. But me personally, I've done 2 of these in my lifetime. So how it works is you have to identify the qualified intermediary. Qualified intermediary is the 1031 exchange company. If you don't know of a good 1031 exchange company, ask the title company that your real estate agent uses. Every single title company has a qualified intermediary, a 1031 exchange company that they use. Okay. What's going to happen is you're going to identify your 1031 exchange company. You're going to list the house that you want to sell with your real estate agent. They are going to sell that property. Up to this point, it's exactly normal. The big difference is here. Instead of that money from the proceeds going to you, it's going to go to the 1031 exchange company. You never touch the money from your sale. Okay, the money goes immediately and directly to the qualified intermediary at the 1031 exchange company, and they're going to hold on to the money until you close on a new house. They will then take that money and send it to the title company on that new purchase. So you're going to sell your property. You now have 45 days to identify a replacement property. Okay. From when you sell your current place, you have 180 days to close on that replacement property. So we got 45 days to identify a new property that you want to replace it with, and you have 180 days in total to close on that property. Once you identify that property, the identification period, and you go under contract on it, you have to close on it within 180 days. At that closing, the qualified intermediary, the 1031 exchange company, will send the proceeds from your first sale to your new purchase. Okay, so the money never goes through you, it only goes through the 1031 exchange company. That allows you to delay paying capital gains. Capital gains can be quite significant. When you go to sell a house, a primary residence, they're going to ask you a couple different things. They're going to ask you, did you live in the house 2 of the last 5 years? Yes, I have, as a primary residence. Did you use the house as a business? I.e., not did you work there remotely during the pandemic? Did you turn your house into a daycare? Okay. Did you operate a gym out of your garage? That's what they're worried about. Okay. No, I did not. Great. Did you sell any other primary residences in the last 5 years? No, I did not. Great. So long as you can answer those questions like that. Yes, I did live in there last 2 years, 2 of the last 5 years. No, I did not sell any other primary residences. No, I did not operate it as a business. Great. You get to protect appreciation in your house. 250, I believe, for a single individual, 500,000 for a married couple. Big tax benefit of real estate. You get to protect appreciation that you've earned in the house. You bought a house for 250, you sold it for 500,000. Very rarely can you just say, hey, great, I made $250,000 and not pay any capital gains, unless it's real estate. Now, if it's an investment property and you can no longer answer that first question correctly, have you lived in the house 2 of the last 5 years? No, I did not. It's an investment property. Great. Now you're going to have to pay capital gains unless you do a 1031. You take the proceeds, you do a 1031 exchange, and you take those proceeds and you invest into another property. People do this all the time. They may have accumulated properties out of state, and then they're moving to Colorado and they want to bring those properties with them. But the properties are in Florida and New York and Boston, whatever. They want to bring those properties near them so that they can manage it better. Great. 1031 exchange. Great avenue, allows you to exchange for a like kind property. Like kind property is very vague. It's intentionally vague. The general rule is it has to be residential to residential. Okay, so you couldn't exchange a condo for vacant land. That doesn't typically work. Again, third time for the day, consult your CPA because they will be able to tell you their interpretation of what a like kind property is. You could exchange 1 property for 3. You could exchange 3 properties for 1. Most CPAs agree along those lines, but it has to be generally residential in nature. Vacant land does not typically work. Okay. Michelle, I think you had a question before I kept talking there.
Oh, let me go here. I apologize for that. Yes, we have a couple questions for you, Erin. Let me go up here to this one and find. Is there a max number of homes a TYP bank will allow an individual to get loans for?
So Fannie Mae and Freddie Mac, again, they're the government-sponsored enterprise behind mortgages. They will allow you to have 10 finance properties. That is their limit, 10 finance properties. Now, they carve out one exception, which is if you're buying a primary residence, they do not care about the amount of finance properties you have. So you could have 10 finance properties, and if you're buying a new property as a primary residence, that's perfectly fine. They do carve out an exception for primary residences, but 10 finance properties, if you're looking to buy an investment property and it's number 11, most lenders are going to really struggle with that.
Thank you. My questions will be more appropriate for later in the presentation. Oh, wait, we have a rental property here in Boulder, and we're going to sell it later this year to better leverage the equity. Will you talk briefly about 1031 exchanges? You just did. And are there special considerations if you're selling in one market and purchasing in another state? We did. Do broker or realtor fees come out of the 1031 for the new purchases, or are they out of pocket for those 1031 exchanges?
Sure. So there's a couple questions buried in there. I think some of it I may have already answered. Downsides to selling in one market and buying another one. The big one for me is this 45-day identification period. You got to be able to come in guns a-blazing and be able to get under contract in that 45 days. So that's the part that can be a little bit challenging in this market specifically because it is so tight. So it's just the timing, and it's always a concern with the 1031 exchange. It's more of a concern in this market with the 1031. In regards to the sales proceeds, so when you sell your current place, in Colorado at least, the seller will pay for the real estate commissions. Okay, so when you go to sell your house, they're going to take your sales price of your house, take off all the fees, including the commissions, and then whatever's left over is the net. That net income is what gets passed along to the qualified intermediary, the 1031 exchange company. So they'll take off the real estate commissions before that money gets passed along to the 1031 exchange company. And then you have to use that money, whatever money was left over, for the replacement house. So yes.
And also another question, can you use the funds from within a 1031 to purchase multiple properties?
Absolutely you can. So you can sell one property and invest in multiple ones. Absolutely. You want to make sure that you're using all the money, because if you don't, you're going to have a fairly significant tax bill at the end of it all. But so long as you're using all the money, you can sell one property and buy three, sell three properties and buy one. Most CPAs will agree as far as that goes, which is it's still like kind of exchange if you sell one property and invest in three different ones, something like that. That'd be perfectly fine. I've seen people do that all the time.
And then one last one, when you talked about using your house as a daycare or gym, does it count if you use a home office deduction on taxes?
No, good question. So most self-employed borrowers are going to have a home office deduction. That's okay. That's perfectly fine. They're really talking about, did you have to change your property to accommodate a business that you were operating? I have seen people turn their house into a daycare. You walked in and you're like, hey, why are all these counters at my knee height? Like, that's kind of weird. They literally converted their house into a daycare. I have seen people operate a gym out of their garage, charging membership fees, and they had everything there. So that's really what they're worried about is, did you change like the footprint of your house to accommodate a business? So long as the answer is no, you're okay. Using your laptop at home is perfectly fine.
Perfect. And then do broker or realtor fees come out of the 1031 for the new purchases?
In Colorado, the seller pays for the real estate commissions, not the buyer. So when you go to buy the replacement property, you are not going to have to worry about real estate commissions in Colorado, at least not 95% of the time plus.
And then what happens to leftover amounts if 1031 exchange purchases less than what you sold? Do the capital gains description then apply to any leftover amounts?
Yeah, there's significant consequences associated with it. You want to make sure you're using all the money. You also want to chat with your CPA about what happens if you don't. There can be some pretty significant consequences there. CPA, 1031 exchange company, talk to both.
Well, thank you for all the questions. Keep them coming, and no more at this time. Thank you, Aaron.
Beautiful. So yeah, love 1031 exchange companies. Great way to bring properties closer to you, to diversify properties. For me personally, what I did was, my strategy has always been kind of second, exploration to my personal world. My strategy was always, I wanted to invest in townhomes, not condos. We'll talk about why, but personally, townhomes. They're low maintenance. They tend to rent out really, really well. Even though they have HOA dues, I was still able to make the numbers work. They appreciate a little bit more than condos do. And ultimately, they're rather desirable. Younger families, young professionals, high school dropouts, divorcees. It attracts a large pool of people, which is why I like townhomes so much. I did not listen to my own advice, and I bought 2 different single family residences at one point as an investment property. I very quickly realized that my original strategy of townhomes was the right one, because they were a little bit more work. One of them had a structural repair. It was a nightmare. The other one was a longer story, but I acquired 2 single family residences, and I wanted to get back in the townhome game. So I did a 1031 exchange where I sold the single family residence, rolled the proceeds over to a 1031 exchange company, and then ultimately buy a investment townhome. So eventually got where I wanted to be, which was townhomes, 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 and only townhomes. I took a detour through single family residences and did 1031 exchange to get back into the townhome game. So that could be one reason why you do it, is to switch up your investment strategy. Like I said, I'll also bring in investment properties closer to you so you can manage them potentially in retirement, something like that. So love that option. Again, it's a way to defer paying capital gains, not avoid paying capital gains. Ultimately, when you go to sell that replacement house down the line, you will be paying the capital gains. So keep that in the back of your mind. Disadvantages. It's not all sunshine and rainbows and puppy dogs, unfortunately. There are some downsides to investing in real estate. Number one, it's extremely illiquid. Maybe not in this market. This market is different. This market is an anomaly, but it's not very liquid, right? If you want to sell stocks or bonds or mutual funds, you can click a couple buttons and the funds are available in 2 business days, right? Not the case with real estate. Real estate has expensive costs associated with selling. Real estate agents can't really tell you how much they make because it's considered price fixing. They're worried about all the real estate agents getting together and setting their rates for the entire market. Since I'm no longer in real estate, I can tell you, a typical buyer's agent, it's not uncommon where they'll receive 2.8%, right around there, plus or minus a little bit. Listing agents, similar amount, sometimes 2.5, sometimes 2.2. Very common for listing agents to receive on the order of that amount. When it comes time to us figuring out how much you'll walk away from in your house, we typically will take off 7% of the sales price for real estate commissions, title fees, prorations for taxes. So it costs money. 7% off the top is a lot of money, right? So it's expensive. It also takes some time. If you want to sell real estate, again, maybe you can get a cash offer and sell your house in 2 weeks. Most of the time, it's a little bit longer. You have to prep the house. You have to market the house. You have to put the house on the market on a Thursday, show it during the weekend, review offers next week. Hopefully you're closing within 30 days of that. But it takes time. It takes less time in this market than normal, but it does take time. So it's not very liquid. You can't just click a couple buttons to get the money out. It takes some time and it costs some money. Real estate has expensive costs. It has high costs. It's got high transactional costs. It has maintenance costs when you're managing a rental property. And even if it is highly leveraged, it still requires a significant upfront investment. If you're going to buy real estate, again, minimum down payment on investment property is about 20%. On a $250,000 home, and good luck finding that in this market, it's going to cost you $50,000. Closing costs and prepaids an additional $5,000 to $6,000. So it is expensive to get into real estate. It's not for the faint of heart. It does require significant upfront investment. Okay, you can get in on a much smaller level with stocks. You can go buy Apple stock for $1. Might not have one full stock, but you'll have part of one. Not with real estate. Okay, it's a little bit more expensive to get into. A little bit. It's more expensive to get into. So there's that. That is a downside. All right. So now we're going to take a look at some numbers. And this is really where I highlight the advantage of appreciation. Okay. So I just ran these numbers yesterday, so they are solid. Found a house that was listed at 341. If we did 25% down, our PITIA payment, so principal, interest, that's what PITIA stands for, principal, interest, taxes, insurance, and association dues would be $1,943. Your initial investment, $90,000. As I mentioned, it's got high transactional costs. It's expensive to get into. Okay, assuming appreciation of 5%, which is pretty mild. I wanted to come up with an example that would, stand the test of time more than just, the next 6 months in a year. 25% down, 6% interest rate. If your renting was $2,000 a month and selling costs were 7%. So these are all the assumptions that I put out there. Okay. After 5 years, you'll have collected almost $6,000 more in rent than you'll have paid in mortgage payments. Your response to that should be, woohoo! Yay! $6,000 over 5 years. Whoop-de-doo, not so great. However, and this is where everything starts changing, you'll have $197,000 in equity. You've got, even though you may only be cash flowing, again, maybe $100 in this case, the tenant is paying not only your mortgage payment, but they're actually paying down your loan. Okay, they are paying down the loan, they are paying the principal on the loan as well. So each month you're setting aside a few $100s in increased equity, in addition to the fact that your house is increasing in value. Minus the initial investment and your selling costs, you're going to have a net gain of $76,000. If we add these two numbers together, we get $82,208 in net income, or a return of 90.8%. Leverage, 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 leverage. That's where leverage exists. You initially invested $90,000. 5 years later, you've made $82,000 on your initial investment. So 90.8% over the course of 5 years. Divide that by 5, 18.16. That is your annual ROI, return on investment. How is that freaking possible? Leverage, leverage. It's all about leverage. I always have members who are like, I disagree. I think I'd be better off not getting a mortgage. That's fine. It doesn't pertain to me. It doesn't affect me at all. You do you. However, to get the best return on investment, it's all about leverage. That is unique to real estate. It changes the game entirely. 18.16% return year over year. That's insane. To prove my point, if you were to do this exact same transaction, but not get a mortgage, okay, there is no 6% interest rate. There is no 25% down. There is no PITIA. There's only taxes, insurance, and association dues, okay? In that situation, you would have received $97,000 more rather than almost $6,000 more. If you take that amount and you figure out what your net gain is, it ends up being 47.4%. Why is that the case? Because you had to pony up 100% of the money in order to get 100% of the return. In the finance version, you were putting down 25% of the money and you're getting 100% of the return. So you could just as easily go buy 4 houses if you did the financing as opposed to paying for 1 house cash. Leverage, 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 leverage. 9.48% return over year over year. Not bad, not bad at all. However, it's not nearly as good as if you got a mortgage to begin with. I understand I'm biased. I am a mortgage loan officer. I would tell you right now that I would be much worse off if I had paid for those houses cash than if I had gotten mortgages. Leverage is amazing. And you're welcome when Michelle sends out these charts to double check my math. But leverage just changes the name of the game. So on that topic, how is financing an investment property different than financing a primary residence? Number one, when you go to buy a primary residence as a first-time home buyer, you can put as little as 3% down. Okay, as a repeat buyer, you have to do 5% down. As an investment property, 20% down. And if you really want to make the numbers work, you need 25% down. Okay. Another big caveat, the funds cannot be gift funds. If you go buy a primary residence, you can totally get a gift for the house. has to be a gift, has to be a relative that gives you the money, but you can get a gift for the down payment on a primary residence. Not the case with an investment property. Okay, with an investment property, it cannot be gift funds. I just recently had a member went under contract on an investment property, and he's like, "Oh yeah, by the way, I forgot to tell you the money's been from a gift." Did not work. We ended up having to tell him to go get a home equity line of credit on his current house, use that as the money to buy the house because that is allowed, and that's what he did, and he just closed a week ago. So gifts are not allowed for the purpose of buying an investment property. If you have somebody that does want to gift you funds and they do want to buy an investment property with you, the option would be to have them on the mortgage. If they're on the mortgage, it's no longer a gift. It's their money that they're using to buy that house. So that would be a potential also workaround. In this case, the member is like, I don't want my parent or grandparent on the loan with me. So we went the home equity line of credit route. As with buying a house, do not hold physical cash. Physical cash is no bueno. Okay. And the reason why is because the government is really worried about money laundering. The vast majority of mortgages are backed by the government. So they don't really want you buying a house with cash that they did not know where they do not know where that money came from. Okay. Cash could be received perfectly legitimately. It could also be received illegitimately. There's no paper trail on cash, and that's why the government's scared of it. Okay. So don't hold physical cash, put it in your bank accounts. You can also do what's called seasoning of funds. Seasoning of funds is once the money is in your bank account for 2 full months, I no longer have to find out where that money came from. So if you do have physical cash, if it is sitting in a safe at home, if it is buried in your yard, dig it up, put it in your bank account, and then wait 2 months and then come talk to a lender. Because when you talk to a lender at that point, the money's been in your account for 2 months, they no longer have to find out where the money came from. Okay. So don't hold physical cash, get the money seasoned. Source of down payment. Ultimately, we need to show that the money is going to be liquid for closing. So savings, checking, money market, those are the 3 acceptable accounts that we want your money in when the time comes. Okay. Stocks and mutual funds are perfectly fine. There's a good chance your lender is going to ask you to liquidate those monies if you're using them for the purpose of buying a house. What that means is simply sell your stocks, bonds, mutual funds, get them deposited into a savings, checking, or money market account, and we'll be perfectly fine. Lenders can sometimes get around that. It depends on how vast and how big the stock portfolio is. But general rule, plan on liquidating the money. Okay. Home equity line of credit, I just alluded to this one. So if you own a primary residence, presumably most of the people on here, you can always get a home equity line of credit on your current house. You could use that as a down payment on an investment property. So you're taking one loan just to get another. If you're up for the risk and we can qualify you with that extra payment, we're perfectly fine with it. Okay. Nope, go ahead, Michelle. Scared you away?
There we go. So my button is kind of punchy. Okay, so those are some great numbers, Aaron. I like that 9.3, but I also like that higher number much more. So this is so interesting to me. So you just covered the recommendations for funding sources. So there was a question on that. Would you recommend purchasing in the state that you live, or would you recommend investing outside your state of residence or in another country?
I don't really have a recommendation there. Anecdotally, I went local. Erie, Broomfield, Longmont, another one in Broomfield, I guess. I went local personally. Just easier to manage, and I know the market here. It's not saying that one strategy is better than another. It's just saying that I am a little bit more financially conservative, I think, and I wanted to be able to drive past my properties and check on them. I also know who's managing my properties, so that brings me some comfort as well. I know plenty of people that have invested out of state and they've done just fine. It really comes down to the management company you use and how much confidence do you have in them, because they're really going to be the ones that are in charge of it. And I'll tell you some stories later on about some nightmares that might, some nightmare scenarios that might change your opinion one way or the other. But anecdotally, I always went local. It's just easier to manage. It's also really expensive here. It would be a lot harder to do today than it was when I did it, 6-7 years ago. So there's that. I understand. And I understand the appeal. My parents have invested out of the country. very different environment, very different. There a whole lot of geopolitical infighting. There was talks about a coup within the government where they bought. So yeah, they are losing some sleep over that too. So overseas concerns me more than over a state line. If you are buying over a state line, make sure you vet your management company left and right, because they're really going to be the ones that are managing it for you. So yeah, that's all I got to say on that.
Thank you. And then how much would you invest in a down payment?
25%. 25% is what I'm targeting.
Okay.
It gets you a significantly better rate. It makes the numbers work. The rate is significantly higher with 20% down versus 25. I wouldn't do more than that. 25 is kind of key.
Okay, great answer. Okay, great questions though. All right, here we go.
Perfect.
Thank you, Aaron.
Of course. So investment properties are considered a higher risk of default. The government's logic there, all things being equal, if times get tough, you're more likely to skip a payment on an investment property than you are on your primary residence. You're going to evict a stranger before you evict yourself and your family, right? So since they're considered to have a higher risk of default, they have higher interest rates. They also have what we call reserve requirements. So reserves are, if you were buying a primary residence, you could bring every single penny you had to closing. Literally every single penny. I had one member one time bring within $5. I actually met with her a few days ago. She's in a much better situation now. She's very happy she bought what she did. But she's like, I can't believe I only have $5 left. I'm like, yeah, I know. I remember that too. I talk about you without using your name all the time. So primary residence, you can bring all the money you have to closing. Investment property, you cannot. They want to make sure that you have, and we're going to be talking about exactly how much on the next slide, but they want to make sure that you have money left over after closing. So it's not sufficient to bring every dollar you have to closing. You have to have money left over after closing. What if it takes you time to find a tenant? What if you have to carry multiple mortgage payments for a period of time? Will you be able to do so? The good news is we can use retirement accounts insofar as you have access to the money. So if you have a retirement account, we have to get what we call the terms of withdrawal. It shows, hey, look, I can access this much for any reason before I retire. That's the amount we could use for reserves. You can take a loan sometimes from your 401k during financial hardship. That's the amount I can use. Okay. Brokerage accounts. I can use 70% of the amount. Why 70%? Because what if the market dropped 30%? It's kind of the government's reasoning there. But I can use brokerage accounts, stocks, bonds, mutual funds for reserves. Okay. Here's a big advantage to investment property. When you go to buy an investment property, I get to use 75% of the anticipated rental income for qualification. Changes the game, changes the game. I no longer am trying to qualify you for an additional mortgage payment. I'm really only trying to qualify you for approximately 25% of one. So it's not uncommon where I'll have conversation with a member and they're like, I'm not sure if I want to buy a primary residence or investment property. Like, how much can I qualify for a primary residence? I give them the number. How much can I qualify for an investment property? Significantly higher. And the reason why is because I can use that rental income for qualification. Like, how could I qualify for more of a rental property than I could on a primary residence? Because I'm adding in an additional source of income as well. So the reason it's 75% and not 100% is because the government assumes your property is going to be vacant a quarter of the year. The vacancy factor in this area is like 4%. Properties just are not vacant. The government doesn't care. The government logic, 25%, they're going to take 25% off the top. They assume your property is going to be vacant for a quarter of the year. That's just not the way real estate works in this area. But it's their game. We're just playing it. Okay. On the topic of reserves. So if you're buying 1 to 4 finance properties, so properties 1 through 4, you can put as little as 20% down. How much do we need for reserves? It's 2% of the unpaid balance on any rental property and 6% PITIA, principal, interest, taxes, insurance, and association dues on the subject property. Okay, quick example. So if we have a $150,000 loan balance and we got 2 rental properties, 300,000, so that's 2 of them, times 2% equals 6,000. Plus I would need your housing payment, $1,500 times 6 equals 9,000. So I would need to show reserves on the order of 15,000. Okay. Retirement accounts are okay insofar as you have access to the money. Brokerage accounts are perfectly fine. If you have a home equity line of credit, we could potentially use that money. You would have to advance the money into your savings account, and then I could use those as reserves. Okay. Immediately after closing, if you decide to pay that HELOC back, God, thank you for the $15,000 in my savings account. I don't need it. And you can just pay it back. But I have to show that that money exists. Properties 5 through 6, same 20% down if you want. Again, 25% down improves the rate. Now I have to show 4% of the unpaid principal balance. And again, 6 months PITIA, principal, interest, taxes, insurance, association dues. Using the same 150 loan balances, same PITIA, 600,000, 4%, 24,000, plus I need an additional $9,000. So total reserves on the order of 33,000. Okay. So it gets more expensive the more properties you acquire. 7 through 10. Now it requires 25% down. 20% down is no longer a viable option. I also have to have reserves on the order of 6%. So it went from 2 to 4 to 6. So if you own 8 properties here, I now need to show $72,000 and an additional $9,000 on the subject home. So $81,000 left over. So again, I need to show money left over after closing. It's not sufficient to bring every dollar you have to close it anymore. Okay. Good news is I can use that rental income to help offset it. All right. Types of properties. So I mentioned at the very, very beginning, well, you lend 1 to 4 units. Okay. Single family residence, which is a standalone home, townhome, home that's side by side typically, and then condos. Typically you have somebody above or below you. The distinction between townhomes and condos gets blurred. Okay. Some condos look like a townhome. They're 3 stories tall. You have a neighbor on one side or both sides, but don't have anybody above or below you. But they are legally a condo. How do you know the difference? It's all in the legal address. Okay, so if you're looking at the legal address on a townhome, it'll say lot 1, block B, something like that. Okay, it's going to be lot, it's going to be block. You technically own the lot you're on. You technically own the piece of dirt that you sit on. That is the definition of a townhome. You technically own the land you're on. Okay, a condo, if you look at the legal address on a condo, it'll say unit A, building 2, something like that. Okay, unit, building. You do not own the land you're on. It is not lot block. You do not own the land you're on. You only own the interior walls, the inside of your unit. Okay. Small distinction there. And why does this matter? It matters because townhomes are easier to get financing on than condos. When you go under contract on a condo, they have to meet the criteria for a warrantable condo. Warrantable is a very fancy term that just means does it meet the government's criteria? A warrantable condo does, a non-warrantable condo does not. Okay. To find out if a property is warrantable or non-warrantable, we are going to be asking the HOA the following questions. Number 1, is there any litigation in the complex? Okay. The HOA cannot be in any litigation, or else it's going to be considered a non-warrantable condo. Most common litigation has to do with builder defects. I'd probably say the second most common is like slip and falls. Somebody slipped and fell, and now they're suing the HOA. So if the complex is in litigation, they cannot get conventional financing. It is going to be a non-warrantable condo. It also cannot be a condotel. A condotel is kind of a quirky quirky property where it has some features of a condo and some features of a hotel. If you walk in and there's a doorman, okay, that could go either way. And then there's a concierge desk, and you're like, that's a little bit unusual. And then they'll have a rental desk where you can just walk up and like rent properties by the night or weekend. Condotel, 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 condotel. It's just as equally a hotel as it is a condo. In fact, most condotels, if not all, they will have a rental pool, which is where you say, hey, look, I'm going to be there Monday through Friday, but I'm not going to be there Saturday or Sunday. So feel free to rent out my place. You enter it into the pool, they will advertise it for rent. And if they can find a tenant, you will get paid for those couple of days that they're there. They'll have housekeeping services, and they'll have bell boys or bell people. They'll have concierge desks. Those are all telltale signs of a condotel. Okay. Government does not want to be in the business of commercial. Condotel hotels are more along the lines of commercial. 15, the complex cannot have 15% or more of the units be delinquent on HOA dues by 60 days or more. It used to be 30 days or more, and then we used to see this issue arise all the time. Once they moved it to 60 days, the amount of issues dwindled quite a bit. It peaked its ugly head up again during the pandemic, the very beginning of the pandemic. people were really struggling. They were laying off people left and right. And because of that, people started to skip HOA payments. It was one of the first bills to stop getting paid. If 15% or more of the units are delinquent on HOA dues, it's a sign that the HOA may be headed for financial distress. If there's too much financial distress, that can make it hard to keep up the property. They're going to struggle to keep up with maintenance. They're going to struggle to keep up with insurance dues. They could be a pretty big issue if too many people are not paying their HOA dues. 20. The complex cannot have one owner who owns 20% or more of the units. They carve out an exception for municipalities. So City of Boulder, sometimes they went out and they bought more than 20% of units, and they did so for subsidized housing. Okay. Hey, we've got low income rentals. Sometimes they acquired more than 20% of a complex accidentally. That's okay. Municipalities are perfectly fine. The government's not worried about them. The government is worried about is if that one owner went into bankruptcy, they would just flood the market with 20% plus the units. That would drag down your value. Supply and demand, if the market just got flooded with 20% additional units, your values would get dragged down. Okay, government's worried about your value as well. 35, the complex cannot have 35% or more of the square footage be commercial in nature. Why does the government concern themselves with commercial? There's really a couple different reasons. Number one, they don't want to be in commercial lending. That's not their purview, is not what they want to do. They're heavily invested in residential. They do not want to be invested in commercial. Okay. Secondly, commercial space can prove troublesome when it comes to sell a house. For instance, if you've ever driven past a commercial unit and you're like, how is that place still vacant? It's been vacant, it feels like, for 3 years now. Yeah, that's the same concerns the government's worried about. Commercial space just has a tendency to stay vacant longer. In addition, if there's unknown commercial space in an area, people may not want to move in, even on the residential units. You don't know what's going to go in there. It could be a restaurant. It could be a marijuana shop. And now you have to deal with the smell all day long. It could be a gun range. It could be a bowling alley. That's going to be loud at midnight. All the things that the government is concerned about. Commercial is just a big unknown, and the government does not like unknowns. Okay. And then lastly, sometimes 50. And this sometimes 50 does apply here. When the purchaser of the unit is an investor, I would assume all of you, at least 50% of the units must be owner occupied. That causes a lot of complexes to be non-warrantable. It is also the single biggest reason why I invested in townhomes and not in condos. It's not that I don't like condos. I've lived in condos. I like living in condos. I like the pool that came with my condo. However, as an investor, it's a lot of complexes do not meet this requirement. Okay. So if you ever see you're looking at condos and it says non-warrantable, 9 times out of 10, it's because of this reason. Okay. If you're an investor, at least 50% of the units must be owner occupied, or else you're going to have to pay cash. Okay. Or you can get a non-warrantable condo loan. Elevations is one of a couple lenders in the areas that will do non-warrantable condos. They have higher rates. They also have less favorable loan terms. You're not going to get a 30-year fixed. You'd be getting an adjustable rate mortgage. Rates fixed for an initial period of time and then subject to change. So it's more of a temporary solution than anything else. But we do offer non-warrantable condos. All right, so you own a primary residence. You're wondering if you should convert your current house into a rental. You want to ask yourself a few questions. The biggest one, though, is would you buy your house as a rental today? Okay, outside of doing the 1031 exchanges, I've sold one primary residence in my life. And I asked myself at the time, would I buy that property as a rental? And the answer at the time was, no, I would not. It was an older home where I saw the roof was going to need to be replaced and the guts of the house, the HVAC systems, the air conditioning, were going to have to be replaced. The carpet was in, getting worse for the wear. The yard required a lot of maintenance. It just would not have been a good rental property for me. It was just too much maintenance and too many costs on the horizon. So I decided to sell it. Tough decision. But I asked myself what I tell people all the time to ask themselves, which is, would you buy the house as a rental today? Does it need a lot of tender loving care to maintain it? The answer was, yes, it did. And I just couldn't come to terms with that. And then lastly, I had to ask myself, how emotionally attached am I to this house? And the answer was a lot. A house is not just a house, it's a home. It's where I married my wife. I had a lot of emotional attachment to the house. And why does that matter? It matters because I was going to let a tenant live in that house. And tenants do not take care of your house the way you do. I just could not come to terms with that. You would be doing not just your tenant a disservice, but you'd be doing yourself a disservice if you cannot let them live in the house, because that's what tenants do. Okay, people drive rental cars faster than they drive their own car. So yeah, ask yourself, how emotionally attached are you to the house? That would be a bad landlord situation if you are just micromanaging them and you're doing monthly checks because you want to take care of your baby. Yeah, you should not be renting out your place. Okay, they are going to live in it, I promise you. And then potential tax implications. That was the last one. I looked at how much I would have paid in capital gains if I turned it into a rental. I couldn't come to terms with that. I decided I was better off taking the appreciation that Uncle Sam wanted to cover for me tax-free and just take that on and move it on to the new house. So definitely those 4 questions you should be asking yourself before you convert your house into a rental. When you're looking at converting your current house into a rental, we look at how we could qualify you, okay? The easiest way is if we can qualify you for both your current payment that you're making as well as the new payment on the new house. If we can qualify you with both payments without having to introduce income, we are good to go. Easy peasy, very straightforward, not a problem at all. If, like most mortals, you need rental income to qualify, we can use rental income on the property that you are converting. We have to get a signed year-long lease on that on the property that you're vacating, and the lease has to go into effect within 45 days of closing. Okay, so give an example. Let's say you went under contract on a new property June 1st, you were closing July 1st. Okay, we would have to have a signed year-long lease on the property that you're vacating in our file, and that lease would have to go into effect no later than August 15th, within 45 days of your closing date on the new property. Okay, so within 45 days of you going into closing on the new property, we have to have a signed, well, we have to have the lease go into effect. We have to have that signed year-long lease in our file by your loan availability deadline. Okay, loan availability is typically 2 to 3 weeks into the process. So you go under contract on the new property, you've got 2 to 3 weeks to get a suitable tenant on your current place, and that lease has to begin no later than 45 days of your closing date on the new property. So it's not like you have to evict your family, move out, and then rent it out. No, but you do have to find a suitable tenant, get a signed year-long lease in your file by your loan availability deadline, and that lease has to go into effect within 45 days of closing on the new property. Okay. All right, tenants. This is where you get to hear all my horror stories. So, if you're doing it, your tenant management yourself, do not skimp. Okay, if you cannot double check their references, do not accept them as a tenant. If you cannot get a credit report pulled, do not accept them as a tenant. If you can't verify their employment, do not accept them as a tenant. If they pay for their security deposit and their first month's rent in cash, do not accept the tenant. They should be financially responsible enough to have a checking account, in my opinion. Those are some very specific examples, Aaron. Oh, yes, they are. When the housing bubble was popping and I was going into property management to, keep the lights on, not only was the real estate market struggling, but the rental market was struggling mightily. I had somebody that just bought a house out in Fort Lupton. They had a man cave. They had a lady lair. They made their house their home. They just loved that place. And unfortunately, they had to relocate out of state for work because the jobs market wasn't doing great. And they had just acquired this house, new construction, and it was beautiful. And they needed to rent it out in a hurry. And unfortunately, the rental market was not great. They had a couple different tenants who applied. One of them, I could not check their references. One of them had a credit score that began with a 5, which was very low. Good credit starts at about 680. Perfect credit starts at 740. So their credit score was in a 5. It started with a 5. I couldn't check the references. They wanted to pay their security deposit and rent in cash. All red flags. They had another option, but the other option, they had pets, and they decided they'd rather take the folks that I couldn't check their references. Credit score was terrible, and they wanted to pay their security deposit cash versus people with pets. Fast forward 2 months later, the security deposit and the first month's rent was the only money we ever received from them. Went back in to evict them. They had already moved out after stealing carpet, after stealing the furnace, after punching holes in the wall. They completely destroyed the house. It was devastating. It ultimately was the push that they needed to list their house for sale, which is what we had been trying to convince them the entire time to do. But they just wanted to hold on to it until the housing market had recovered. Ultimately, they ended up selling their house. They got their money back. Their insurance took care of a lot of the damages, but the damage was done. If it seems, listen to your gut. If it just seems wrong, it is. If it seems like, oh, this might be a warning flag, it is. It is. I would much rather charge less in rent and have my pick of lender when it came to tenants than set the price so high that I was really limited to only one option. That's a dangerous position to be in. I would rather undercharge and get somebody in there right away. 1 month of skipped rent, as you wait and wait and wait to find tenants, you'd be much better off charging less, getting somebody in there sooner than overcharging and only getting one choice and having to be vacant for a period of time. So yeah, check their references, require them to fill out a full rental application. You can find them online. Review their credit report. You can find some websites that will check their references and pull credit for you if you want to do it that way as well, and that's a viable option. But listen to your gut. Listen to your gut. Listen to your gut. Listen to your gut. I can't. It's absolutely devastating if you don't. It's your house. Make sure you're taking care of it. Protect your investment. So be very clear with expectations up front. The management company I use, they will do a spring and a fall inspection on the house. They take care of the house better than I did. So be very clear with your expectations. My management company that I use is very, very good at that. We will be doing spring and fall inspections. They treat it like a courtesy. Hey, what's going on with the house? What do you need? You know, I noticed there was a hole in your screen. Do you want us to replace the screen? I mean, so they use it as a courtesy to make sure that not only are they managing expectations and making sure the tenant takes care of it, but they're also taking care of the tenants. Like most relationships, you get out what you put in. Inspect the property quarterly. My management company does it twice a year. That's sufficient. When I was managing them myself, I did not do it. I did not do it. I got complacent. I got busy with work and I just let that fall by the wayside. I wish I hadn't. My management company takes care of the properties better than I do. Start with a solid lease. If you Google Boulder model lease, you can find the lease that they use for City of Boulder. You can find all sorts of different leases. Management companies, they'll have their own typically. Use a professional for taxes at least the first year. Highly recommend that. It's very easy to use TurboTax and TaxLayer and all those other websites. I highly recommend using a professional for taxes at least your first year. They're going to let you know what to do. Be responsive. Again, you get out what you put in. If you are responsive and take care of their concerns in a timely fashion, they are going to take care of your house better. I promise. Know yourself. Know yourself. To thy own self be true. If you can't do one or more of these things, then you really need to hire a management company. And that was the realization I came to. It was when I invited my tenants to my wedding. And I was like, oh yeah, you guys are pregnant. So I guess we won't be increasing your rent next year. I was way too close to the situation. I was way too, when you're inviting tenants to your wedding and you're giving them breaks because they have a kid, you need to take care of yourself and your family as well. And I was just way too close to the situation. Yeah, not great. I just, not to get into too many graphic details, but I remember being at their house, plunging their toilet for them. And I'm like, my time is better spent elsewhere. I really should not be doing this. I'm the least handy person in the world. Whenever there's more than a broken light in my house, I have to call an adult. I am like the least handy person. I should not be doing property management. I was not doing what I should have been doing. So I ultimately hired a management company. Okay. A management company is going to evaluate potential tenants on your behalf. They're going to perform routine maintenance at your expense. So you'll notice that your next month's rent check will be a little bit lighter. They took care of something that occurred. They'll let you know what they are. They keep track of the books. Every year I get a write-up of exactly what expenses were paid out, what costs arose. So those are all deductions when you take care of it that way. It's going to reduce the amount of taxable income you have. Again, something else I wasn't doing. I wasn't keeping track of great books on the properties. Average cost, typically it's 10% roughly of your monthly rent. For that first month's rent, it's going to be closer to 50 because they have to vet tenants and do background checks and check references and applications and show the property and all that. So it's typically 50% of the first month's rent and then 10% monthly going forward. If it's a shorter term rental, it's going to be more, typically 40 to 60% because they have to do significantly more work. You might have 3 tenants over the course of 3 weeks. A lot more cleaning, a lot more vetting, a lot more maintenance, a lot more everything. So expect to pay more for a management company if it's a mountain property, or sorry, not a mountain property, short-term rental. Okay, VRBO, vacation rental by owner, short-term rentals, all that's going to require more money. It is your responsibility to make sure that you are complying with local laws. Okay. If somebody has a physical disability, you cannot just say, hey, I don't want them to be in my property because that's going to require wheelchair access. My house is not built for it. No, it's your responsibility to provide habitable housing. So you really need to know what your limitations are. If you don't know, you can take real estate courses. They teach an entire section, an entire book on tenant management, rental properties, property management. You can also hire a property management company who has already been vetted and licensed and can take care of all that for you. But do know that it's not just, hey, I didn't know. It's like any other law. You are agreeing automatically to abide by those requirements, even if you're not a licensed real estate agent. Okay, so if you are going to go it yourself, make sure you do your due diligence and research the local laws and regulations. You do not want to get in a bad situation. Okay, take care of yourself. All right, analysis. So looking at a couple quick properties, and then I'm going to show you how to compare different types of rental properties. And I think that'll kind of take us to the end here. So these are 2 real scenarios I came across. One was for 370, one was for 380. One was in Longmont, one was in Lafayette. 25% down would have been $92,500. Here's the principal and interest, taxes, insurance, HOA dues. Total monthly cost was $2,043. Property would rent for $2,100. So I was only making $57 per month on this one. This assumes no vacancy. Your property is going to be vacant part of the year, right? You might have a month or 2 between tenants. It might take you a month or 2 to find somebody to actually live in your property to begin with. It does not account for any future rent increases, which will certainly happen. It also doesn't account for any maintenance. A rule that you will see thrown out there is that you should be setting aside 10% of your monthly costs each month to account for any repairs that might need to be made to the house. Okay, so 10% of your monthly costs. In this scenario though, 5% appreciation, 7% selling costs, you'll have made 88.4% return over 5 years or 17% each year. Again, leverage, 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 king. Leverage is king. Similar scenario, rent was a little bit higher, price was a little bit higher as well. Net income was very similar. Again, assumes no vacancy, there will be some. Assumes no maintenance, there will be some. And it does not account for future rent increases either, which there definitely will be. To compare investment properties, you have a couple different options. Okay, neither one is perfect, and I'll explain why. But if you're trying to figure out, like, hey, look, I'm looking at a bunch of rental properties, I'm just not sure how to figure out what, what's what and how to, compare the different types of properties, single family versus townhome versus condo. Capitalization rate is one way, so cap rate. So it allows you to compare the net return on different investments. So what they're looking at is they're looking at simply the net return. They're going to multiply it by 12, divide it by the sales price, and then they're going to get the cap rate. You want the higher one. The higher one is going to be the better investment property. Okay, that is one way to calculate rental income. It is flawed. I'll explain why it's flawed in a second here. But that's one way to calculate a cap rate and find out if a property is going to make financial sense. Second one is what they call gross rent multiplier. Okay, so gross rent multiplier, it allows you to compare the purchase price to the rents before expenses. Okay, in this one, lower is better. I recommend running both equations, cap rate and the gross multiplier rate, and compare both of them. So in this case, $2,000 times 12, 370 divided by that gave us 14.68. The other one was 14.39. Again, lower is better. So the second property in Lafayette would have been better in this case. It would have been better in the previous scenario as well. Now, why are these two both flawed? It's not that it's not worth doing. I've done these equations on every property I've ever purchased, but they are both flawed in their own ways. And here's why. Neither calculation takes into account appreciation. And as you've seen from all the examples we've alluded to so far, appreciation is huge. Appreciation is huge. If you just looked at the net income, it wasn't great. If you looked at the appreciation, all of a sudden everything made a lot of sense. Neither calculation takes into account a vacancy factor. Again, your property is going to be vacant. Even in this market, it's going to be vacant for a period of time. Okay. Cap rate may make the figures look deceivingly bad if you're opting for a short-term mortgage, because all they're doing is looking at the net income. If you want to take the cap rate a step further, what you would do is you would look at how much of your payment is going towards principal each month, and you would add that to the cash flow. Okay. I have this conversation with my wife all the time. I love my wife. She's my favorite person. God bless her. She's a language art teacher. This is not her forte. And she'll admit as much. So we had several rental properties and she's like, why are we doing this? We're on 15-year mortgages. 3 of them at the time were on 15-year mortgages. The incoming amount is less than the outgoing amount, so we're losing money each month. Why are we doing this? I'm like, oh yeah, no. So each month, $750 of those payments are going towards our pocket. It's a very delayed CD. You know, it's going towards principal. It's paying down the loan. It's building up equity in the house. It's there. It just doesn't seem like it is. And she's like, okay, I'll trust you. Like, taking into account the amount that you're paying yourself towards principal each month will change the equation. Okay. Look up a loan amortization schedule, figure out how much you're paying yourself towards principal, and then run the equation. Add that to your cash flow. That's a better representation of how much are you actually making. Okay. The tenant is paying down the principal on your loan. Hell yeah, you should definitely take that into consideration. But if you just look at the cap rate and you just look at the net income, yeah, you're like, this doesn't make a lot of sense. My cap rate is extremely low. Yeah, add the principal to that. Okay. And make sure you're also taking into account appreciation. Gross rent multiplier, flaw with that one. It does not take into account maintenance costs. They simply look at the monthly rental income. Okay, great. Single family detached home is going to have more maintenance than a townhome is going to, or a condo is going to. Okay, so they assume the maintenance costs are the same between those two different types of properties. Definitely not the case. Townhomes, your HOA dues are taken care of. They take care of the siding and the roof and the painting. They take care of all of that. Single family home, not the case. You need to factor that in. Okay, so both calculations are flawed in their own way. That's not to say they're not worthwhile, but they're both flawed in their own way. Okay, so do your due diligence, think long and hard, ask your real estate agent. They'll have some analysis that they do as well. It's my 2 cents on that. Again, it's not that it's not worthwhile. It's just, you need to take it with a grain of salt, just like anything else. All right, and with that, what other questions do we have?
Let me flip this. Wow, that was such great information. My husband was coming by going, okay, he's good. I got to listen in on this one because we've considered purchasing, a townhome or a condo, especially while the girls, have been in school and now Connor. But if you do have any questions, go ahead and submit them in. I don't see any right now, but if you think of some and you want to just send them my way, we will get them answered, or you can send them. Here is his information right here on the screen. And we are just thrilled that you joined us today. Your financial well-being is extremely important to us at Elevations, and having these webinars, I learned so much as well. There is a question. Okay, how do insurance rates for rental properties compare to your primary residence?
Very similar, very similar. A tenant is most leases require that they have a tenant policy to protect their contents and stuff like that. You don't want the tenant suing you if a pipe burst and now their stuff is damaged. So a tenant is typically going to have a tenant policy, and then you'll have a landlord policy. Together, the costs are very similar to a normal HO3 policy, which is what you have on your own home, or an HO6 policy if it's a condo or townhome. So very similar.
Okay, and we will be, there were questions about the recording and the slides, and we will be sending you a follow-up tomorrow, and it will include a survey. We value your thoughts, and we will include the slides, and if we have to get it approved, but yes, the recording will be included as well. So again, we appreciate your time today, and if you have further questions, please don't hesitate to reach out, and if I don't know the answer, I know I will ask Aaron for most of it, or if I can get you to the right person. So have a beautiful day today, and thanks again. Bye, everyone.
Thank you.